When I did my Q&A this past week, I got to one comment, ran right over because of the first line about a wealth tax, and the comment, I highly disagree, and that's about as far as I went. I didn't want to read the setup because there's nothing you can say to me that would get me on board with a wealth tax. The person then said, you didn't even read my comment, which I didn't. So I will read it this time, and then we will tear apart that comment. It starts off with, I highly disagree about a wealth tax, but then in this whole paragraph is not really talking about a wealth tax, it's talking about the difference between taxation on capital versus taxation on labor, and that labor is taxed at a much higher rate than capital. So let's see if we can sort of dismiss that argument as well. And along the way, we'll make sure we're clear about things we're saying. And as far as a rhetorical argument, this is using a particular technique of dichotomy, which means you have two examples at opposite ends of the spectrum. And I'll show you a technique that you can use that creates an equivalency, which then brings them both to the same point on that spectrum. Okay, this is not about, before we do this, what do you think? Do you think that capital should be taxed at the same rate as labor? Capital in all its forms should be taxed. The return on capital should be taxed at the same rate as labor. Obviously, the way I started this video, you know that I disagree. I'm going to lay out my argument of why. This is not about, you didn't work for it, so it's not fair. It's about work currently being taxed at much higher rates than capital. We're going to stop right there. This is not about wealth tax, right? So the intro is sort of misleading. But let's stop right there. Capital is made up of debt, and it's made up of equity. The return on debt is interest, and depending on how you buy it, you may get a capital gain. Capital gains are both long-term and short-term equity. You can get dividends, and you can get a capital gain, which has both a long-term and a short-term version of that capital gain. So let's just make sure it says that we understand this. It's about work currently being taxed at much higher rates than capital. Let's see if that is generally true or generally false, because we hear that a lot. Interest is taxed at your marginal tax rate. It is taxed at the same rate as your labor. If you're in a 40% tax bracket, you pay 40%. If the person next to you is in a 53% tax bracket, on the same interest income, they pay 53%. Now, the capital has done the same work, but somebody's paying 53% on it versus 40% because it's taxed at the same rate as labor. So obviously the person didn't mean that return on capital. The dividend is taxed at the same rate as labor. It's just that the taxes come from two different sources. The corporation pays tax, and then you pay tax. Now, you'll get a preferential tax rate on your dividend for the simple reason that tax has already been paid on it. But in the end, the combination of what the corporation paid and what you paid is your marginal tax rate. We can get rid of that. It is taxed at the same rate as labor. So it must be the capital gains. But a short-term capital gain is income. It is taxed at the same rate as your marginal tax rate, which is the labor rate. So it is taxed as labor, so it can't possibly mean that. And we can get rid of the short-term capital gain over here. So the only thing that has a preferential tax on it is the long-term capital gain, but that is not entirely true either. If you are holding assets in a pension fund or a retirement fund, when you take that money out, all of it is taxed at the rate of labor, regardless of how it is earned. So all of the money earning capital gains in pension accounts is taxed at the rate of labor. The universe for preferential treatment on capital is getting smaller and smaller, isn't it? This is gone, this is gone, this is gone, this is gone. Anything in a pension fund is gone. So it really is, you're holding something for that qualifies as a long-term capital gain, and you do get a preferential tax treatment on it. Maybe that's what our author here means, is that in that case, it should be taxed at the rate of labor. That's a very rather narrow case overall, but just so that we're clear, a lot of the returns on capital are taxed at the rate of labor already. Let's take an example, and whenever anybody starts with, let me give you an example. Let's take two people. I guarantee you they're going to set them up at really opposite ends of the spectrum. And if you look at the words they use, you can always tell which side they're on, because one side will be described in glowing terms, another side in less glowing terms. Let's say person A, we have A over here, B over here, was born into wealth. Look at the extreme example. They didn't earn it, they're born into wealth. We're going to create equivalency in a minute. Invest 6 million wealth into a passive ETF. So 6 million earning 5%, 300K. We're making the assumption here that that 300K is all long-term capital gains, that there is no unrealized capital gains, and that person is realizing long-term capital gains every single year. What is not talked about is, where did the $6 million come from? The $6 million is an after-tax amount. It doesn't matter who paid tax on it. It doesn't matter if your father paid tax on it and gave you $6 million. Your father has already given the government, has already given society probably 50% of what was earned. So your father probably made $12 million just so that you can have $6 million. So we are comparing an after-tax amount here. When we talk about this person making the same amount of money, this is a pre-tax amount. So the author here wants you to compare an after-tax amount with a pre-tax amount as their equivalency. 5%. He is taxed at 20% capital gains rate, paying $60K. In the meantime, person B works as a scientist on cutting-edge innovations, also earning $300K pre-tax, the $6 million he was using post-tax, but putting him in a much higher 35% tax bracket. So is this person. So is this person who got the 12 to get the 6. So this person here is at 300. Well, this person paid the labor tax rate to get the 6. So do you. You're not exempt from that. You're trying to compare a post and a pre-tax amount. Now, here's where the rhetoric kicks in. Whenever you're reading something, pay attention to the type of language chosen. Even though person B is adding much more value to society, how do you know that? How do you know person B is adding much more value to society? You're making a value judgment on what the person is worth to society. What if the $12 million that was earned here was earned by somebody who cured cancer, had $6 million left, and is earning $300,000? You can't say that this person is a better person for society than person A over here. That's a leap that you've made. I dismiss that. He is taxed at a higher rate than person A. He's not taxed at a higher rate. Pre-tax amount, they're going to be taxed at the same rate pre-tax, if we assume that that is the highest tax bracket. And person A, who is, look at the language, simply following a set and forget passive investment and laying on the beach, just loafing around, hanging out. Look at the language. I would argue that the mere possibility to even earn passive returns on capital is a direct result of all the infrastructure set up by society. Let's stop there. How did that infrastructure get paid for? It got paid by the taxes this person paid. This person has already paid for the infrastructure. In Canada, I was taxed at 53.5%. To then say, oh, your business is using the infrastructure, I would then say, yeah, the infrastructure I've already paid for. I've already paid for it. That's like saying, well, the only reason you're getting to work is because of the value of the car you bought. Yes, that I've already paid for. I've already paid for that infrastructure, and with a progressive tax rate, I paid more than my fair share. If you think that fair share is costs divided by n being the population, I've already paid more than my fair share for that infrastructure. So we can dismiss that part. It does not matter whether the return on capital was made because of the infrastructure. when I've already paid for the infrastructure, right? I've already paid for that. That's already in the income tax. I've already done that. So we can get rid of that. Therefore, if anything, passive. And so the argument, I can dismiss the argument and stop right here, because they're setting it up saying that the capital is a direct result of this, therefore, passive return on capital should finance public expenditures at higher proportions. Well, we've already eliminated that. We can eliminate the therefore, because the premise is false. If the premise is false, the conclusion is false. So we can eliminate the conclusion. So let's get rid of this dichotomy and create an equivalency. It'll be the equivalent thing, but we're just going to change something. We're going to take this over here, this person A, and we're just going to slide it over here and say, this is now the same person. This is a person who earns an income, who pays taxes, which pays for the infrastructure, as we've already said, and over time builds up a portfolio of, we'll call it cash to invest, does invest, and earns another $300,000 on top of that. Now we can't say that this person is not contributing to society. We can't say this person was born into wealth, that we can't say this person is loafing on the beach. We have the same outcome, right? If we're making the case about capital being taxed at the rate of labor, you can't set up an argument saying, here's somebody contributing nothing to society and laying on the beach, because now you're bringing the behavior of the person and you're making a subjective assessment about the contribution of that person to society. Let's make it the same person. So the question we now must deal with is, should this $300,000 earned on after-tax income, after tax, this is savings, after tax, should that income be taxed at the same rate of capital? We've already seen that most of it is. If they're earning interest, taxed at the rate of labor. Earning dividends between the corporation and the individual, taxed at the marginal rate of labor. Short-term capital gains, taxed at the rate of labor. It's just the long-term capital gain. So we're just going to pay attention to the long-term capital gain. There are two ways to approach an argument like this. The real world is messy. It is complex. If you attempt to justify the existence of the real world as it is, you leave yourself open to multiple lines of attack. There is no shortage of lines of attack in debate that you leave yourself open to. So what you want to do is you want to use a logical trick, which is to talk about the opposite of it. So instead of justifying why something is, what we can do is argue that if something is not, it would be highly undesirable. Hence, whatever is must be more desirable than what is not, and then we are done. So let's think of a world in which all capital, long-term capital gains, short-term capital gains, dividend interest is taxed at the rate of income. And since it is only going to be the highest income earners who are able to save a critical amount in which to invest, because the bottom 10% don't have savings, the bottom 70% really don't have savings. It really is the savings really accrue to the top 10, 20, 30% in a society. So we can make the assumption that all the capital will be taxed at the highest rate possible. There are a number of implications if that happens. Number one is valuations. Because there is no opportunity for me to receive a preferential tax treatment on the capital gain, it would tend to keep the valuations of businesses lower. And capital gains is one way of wealth creation within a society, which means you're holding down the level of wealth creation, because I would argue that my after-tax return is the same as my after-tax return on everything else. But if I had a preferential tax return on long-term capital gains, because that is desirable to get, it does bid up the price of assets that do produce long-term capital gains. So you would have a lower level of wealth creation in a society. Number two, equity is risk. Holding something for a long period of time has a lot of risk to it. So if my taxes paid are indifferent between long-term and short-term capital gains, whenever I have capital gains, Why would I risk it? Why not take it immediately? Because there is no benefit to me holding longer. You introduce more volatility into priced assets. As it stands right now, I know that when I go 10 months on something, I say, that's a pretty good return. I think, yeah, but that, if I take it now versus waiting another 2 months, if I wait another 2 months, so you wait another 2 months, it reduces the volatility of assets that are out there. When you reduce the volatility, you also raise their valuation, more wealth creation, especially in those pension funds where, remember, everything is taxed at the rate of capital. You want those assets to grow as much as possible. Finally, probably the bigger one is the growth within an economy is highly dependent on the level of capital in an economy. Case in point, let's go back to 1980. Let's just look at, you can pick any decade you want, but I don't know, let's go 1990 if you want. And let's look at the population of China. Let's look at the population of the US. China, lots of labor, no capital, very little capital at that time, whereas the US, very small population, but a lot of capital. Who was the winner? It's called capitalism. If labor were the necessary ingredient for wealth creation, China would have been the richest country on this planet by a country mile decades ago. Same with India, decades ago, but no capital. You need capital. Without capital, labor just sits around and does anything. So capital enables labor, not the other way around. Capital enables labor. Now let's think about a situation where here is a bunch of countries in the world in which there's no preferential tax treatment, and you open up one country which does have preferential tax treatment. And you have very high populations here, lots of labor, very low level of labor here. Capital will flow to this country here. Capital will flow to that country. So if you think it through and you eliminate the preferential treatment on long-term capital gains, you would end up with a world with much lower valuations and much higher volatility. Probably a world in which more risk capital would lean towards a loan as opposed to equity, because I'm taxed at the same rate. Where's my motivation to take on a hell of a lot of risk when I'm taxed at the same rate? If you did not have preferential treatment on long-term capital gains, you would create it. You would say, you know what would spur a whole bunch of investment and a whole bunch of job creation and a larger tax base to be able to increase the infrastructure and to be able to start with some social programs. What if, now this is a crazy idea, but follow me on this. What if anybody who is investing, and for the long period, we don't want this investing for 2 months at a time and selling, but what if they invested for a long period of time? Do you think that maybe we could give them some preferential tax treatment? If we did, it would draw money into that type of investment. If you didn't have it, if it didn't exist, you would create it. And since we do have it, we don't need to justify why it is. We just need to recognize that if it was not, we would make it so. And there we go. Let's just sort of wrap this up. This really had nothing to do against a wealth tax. I highly disagree against my wealth tax. Has nothing to do with a wealth tax. Describes a system down here saying a very high VAT, 20 to 25%. That's a regressive tax. That would be a very regressive tax. And that would reward savers, which is what we want to do. We can reward savers, but in rewarding savers this way, you have a much lower level of consumption, and you'll end up in a suboptimal equilibrium. If you want to reward savers, but not end up in a suboptimal equilibrium, why not say, listen, after you pay all the tax, anything you earn on that, if you earn it in a particular way, we'll give you a lower tax rate. Now you're rewarding savers in a way that spurs investment as opposed to rewarding savers in a way that lowers consumption. I would eliminate that. 2% wealth tax, I would get rid of that. You're saying excluding real estate. We already pay a wealth tax on real estate. I would exclude that altogether. A 1 to 2% land value tax. I thought we were sorry, excluding, that's right, excluding, I thought you meant including 1 to 2% land value tax. We already have property tax, and that goes to the municipality. I think you're trying to calculate just revenue on the basis of the federal, but what about the state? What about the municipality? All property tax goes to the municipality, right? Taxes of negative externalities. Who decides what's a negative externality? How do you measure that? And remove all other taxes, including income tax. That would be a bad, bad mistake. You would have a regressive tax system. You would have a much lower level of equilibrium because I would be rewarded by not spending. I would simply say, if I don't spend, I don't have to pay the tax. So you would have very high savings rates because that's what would reward savers. What you want is a high level of consumption, while at the same time rewarding savers. You reward savers after they do something, not before they do something, right? So there we are. Job done.